Why did U.S. oil prices hit negative territory? An unprecedented fall in American crude oil sales has added to the hardships caused by coronavirus. So, what will that mean for the U.S. and the global economy? This is Inside Story. Hello and welcome to the program. I'm Rochelle Carey. It's one of the world's most valued commodities, but the coronavirus lockdowns have overturned the dominance of oil. The worth of a barrel of U.S. oil fell to less than nothing on Monday. That's the first time in history the price has turned negative. So this means producers ended up paying buyers more than $30 a barrel to get oil off their hands. It rebounded slightly to just over $2 the next day. That jaw-dropping slide is because the world has more crude than it could use, and storage facilities and even ocean tankers are filling up. Oil is traded on future contracts, and fears of not finding a place to put oil in May means nobody wants crude. That's led to a severe drop for West Texas Intermediate, a benchmark for U.S. oil. The international benchmark for oil, Brent crude, also went down to its lowest in 18 years. So let's have a look at how events reached this point. The demand for oil has dropped by 30% since travel restrictions were imposed, factories shut, and people stayed home to stop the spread of COVID-19. Oil-producing nations, mainly Saudi Arabia and Russia, kept pumping throughout March and into this month. They've since agreed to cut production by almost 10 million barrels, but that was still less than the decline in consumption. Saudi oil tankers heading to the U.S. threaten to worsen oversupply problems for American producers. Donald Trump says his administration will look at blocking them. Trump downplayed the historic drop in oil prices as a short-term problem and said the U.S. could buy barrels to top up the nation's strategic petroleum reserves.
Much of it has to do with short sellers. Much of it has to do, if you look a month into the future, I think it's at $25 or $28 a barrel. So a lot of people got caught. They got caught, and there are a lot of people that are not too happy because they got caught. So if you take a look at it, you'll see it's more of a financial thing than an oil situation. But because you take, I believe, in a month or so, in other words, go a little bit out, it's at $25 and $28 a barrel. So it's largely a financial squeeze, and they did get squeezed. This is a great time to buy oil, and we'd like to have Congress approve it so that we could, instead of just storing it for usually the big companies, because I think we have 75 million gallons right now capacity. That's a lot. It's we've been building it up over a period of time, but that's a lot, 75 million barrels. So we're going to get either ask for permission to buy it or we'll store it. One way or the other, it will be full.
Let's bring in our guest from Houston, Bob Kavnar. He's an oil and energy industry expert. From Bern, Cornelia Meyer, CEO of Meyer Resource. She's a oil and gas expert. And from Bangkok, Stephen Ennis, Chief Global Market Strategist at AXA Corp, a global institutional financial services company. Thank you all for joining me. So since this has happened, this drop, the word catastrophic, among other words, has been used. Bob, is that appropriate? Is it that bad?
Well, when you think about the oil markets, at least the way we look at it here, is that there's a financial market and then there's the physical market. The physical market is certainly in a terrible shape just because we're down 35 million barrels a day in demand. On the financial side, the catastrophe yesterday was people trying to roll out of their May contracts. And there were a lot of contracts that were long, a lot of holders of long contracts who couldn't unload them. And finally, the price went negative as people were trying to settle those contracts.
Thanks for making that very clear for a lot of us that don't speak oil. That was actually extremely clear. Thank you for that. Cornelia, how would you describe it?
I would concur with the previous guest, and I would say one thing that we have to look at, the situation is very dire because we have a demand overhang of anywhere between 30 and 35 million barrels a day. But what we have to put this in perspective is that WTI is the U.S. benchmark, and it's priced at Cushing, and storage is running out or run out or either spoken for in Cushing. It's a little bit different. That explains the differential between Brent and WTI. For Brent, which is sort of a seaborne global benchmark, and therefore it's also in terrible shape, but it's not gone negative because it has places to go.
Okay. Stephen, before I come to you, since Cornelia brought up West Texas Intermediate, I'm obviously going to go back to Bob in Houston. Bob, what is the difference in storage when it comes to WTI and Brent crude?
Well, as Cornelia said, Brent tends to be a more global price, and a lot of Brent is on the water going from one country, primarily the Middle East and other countries, to their export markets. In the States, we were producing about 10 million barrels a day. And with demand being destroyed here in the States and the export market for us, we've been filling up storage, and storage is just about full, both on the SPR, which is the Strategic Petroleum Reserve for the government, and for private commercial storage. So that's caused a lot of the wells to shut in. We believe right now over 1 million barrels a day of production have been shut in already, and I would expect another 1 million or 2 to shut in because storage is becoming full.
Cornelia, I see you wanted in on that. I'm coming, Stephen, I promise.
Yeah, I would totally agree. I would say it's 3 to 3.5 million that will be shut in, and we have to look at the broader ramifications, because when you look, a lot of these companies wells that are shut in are smaller shale producers that have a higher cost base and highly levered, have a high leverage. So this will have a ripple effect into the banks that lend to them, because if they go bankrupt, their loan portfolios deteriorate.
So, Stephen, so Cornelia and Bob have explained, what West Texas Intermediate as opposed to Brent crude oil. But is Brent, is it going to be in as bad a shape as WTI?
Well, it's pretty interesting. It seems that not only are oil tankers reaching saturation, but a lot of oil traders are also. Very bizarre markets that we're going through right now. I think we have to take some value as to what happened to this settlement date. I think it's easy to discount it because we had a massive U.S. ETF fund that had to roll a substantial amount of position that's coming under questioning right now.
Wait,
whether
Stephen,
this is going to actually.
Could you explain that just a little simpler for our audience, if you don't mind?
Oh, sure. Right now, what we have is we have a large retail propensity, or a large retail investment into an ETF fund right now. That's grown quite substantially throughout 2020. This is despite the fact that oil prices have been coming down. So in other words, investors have been trying to pick bottoms here. Now they're running around 11 billion worth of US dollars in long oil positions. And this is really the bulk of the WTI position. That all came to market all of a sudden, and obviously an ETF fund can't take delivery. So they had to roll the position, and this caused a lot of negative action on the short month, which was May. However, going forward, we have to figure out what this is going to mean for Brent. Now, is it going to have a knock-on effect? Well, the guests have correctly alluded to the fact that, we've got a seaborne market, but storage tanks are filling up everywhere, and this is a problem. Where we're going to have a similar event that's going to happen in Brent. Perhaps we could, and I think this is why you're seeing the market start to hedge forward. In other words, roll those contracts more proactively ahead of the settlement dates, and this is why oil is going to remain under pressure, most likely, notwithstanding the fact we could see the USO, which is a large ETF fund, start to liquidate those oil positions, which will also compound oil market problems going forward.
Bob, in some ways, what we're going through now is obviously not predictable per se. But in some ways, was it predictable that this would happen once economies started to shut down and it was the next country and then the next country and the next country? Was it predictable that something like this would happen when there is no demand?
It's been a real concern for quite some period of time. The problem that we've had, especially within the independent markets here in the States, is that we've continued to return negative equity returns to investors. And so investors have fled the space, and they fled the space as long as 2 years ago. And equity financing has become more and more difficult. And as Cornelia mentioned,
So
debt has
can I stop
yeah,
you for a
go
second?
ahead.
I want to keep it as simple as possible. So you're saying that in a lot of ways, the industry was already in trouble before something like this happened?
We tend to do this to ourselves. We over lever. We drill a lot. We develop new technologies that allow us to drill wells at lower cost, which increases production. In fact, it increases production so much we changed the laws in the states a few years ago to allow U.S. companies to export U.S. produced crude, which was against the law up until about 2 or 3 years ago. And so now we developed our own export market, producing more and more crude, importing less from the Middle East and Canada and other places. But we've continued to increase supply even as conservation and slowdowns in the economy in 2009 and 2015 have it's slowed the growth, the demand itself. And so we've created this problem over a period of time. And now we're to the point where we're over levered, overproduced, and now with these low prices and serious crisis. Just an anecdote, I was talking to one of my engineer friends yesterday, and he's an advisor to banks, and he has 15 companies with banks right now that are in the process of restructuring their debt. And that's just the beginning.
Wow, that's a lot. Cornelia, I saw you nodding. You have some thoughts on what Bob was saying about how, in some ways, the industry sometimes does it to itself?
Oh yeah, we are a classic boom to bust to boom industry. We do that all the time. But there's one other thing that I would like to mention, and you saw that with the increased output out of the U.S. You know, the U.S. became about a year ago the largest producer, surpassing Saudi and Russia as who were the two largest producers, who are still the largest exporters. With that, you had this formation of OPEC plus OPEC and their friends who sort of balanced the markets, always taking the pain, always taking crude out of the market when there was too much crude on the market. But what happened last March is Russia would not play ball, and Saudi Arabia said, well, if you're not playing ball, we are not taking all the pain. So there was a price war happening. So on top of the demand shock that we saw a supply shock of the two largest exporters just producing whatever it could be. So we do it to ourselves, and our behavior does not always help.
Stephen, what of this price war that was going on between Russia and the Kingdom of Saudi Arabia? Nothing happens in a vacuum. This has been happening against the backdrop of what's happening with coronavirus. What role do they play in digging the industry out of this?
Well, it's interesting because it was always an issue as far as Russia was concerned about a piece of the pie. They've always applied some type of pressure going into virtually every OPEC meeting by sort of, well, we're not going to comply unless you give us a bigger piece of the pie. That's been a running debate. However, I think they were a little bit sideswiped when this price war happened, simply because COVID hadn't exploded. It looked at that time it was just going to be a temporary phase and everything was going to return to normal. Then, a week after they started the price war, then an explosion, super spreader happened in Italy. Then lights went off everywhere and everything went into the doom and gloom cycle. And this is really what happened. Who's responsible? Well, I think the only way you're going to be able to dig out of this mess, quite frankly, it's totally unexpected. Nobody's fault. It's just a virus that's affected the world. Going to have to be coordinated interventions, not only by OPEC, but also OPEC and friends, but also G20 producers. And this is going to be necessary. Now, legalities dictate that G20 and free and open economies, you can't really regulate people to shut wells down. But there's going to be two ones. Either there's going to be voluntary shut-ins or simply organic shut-ins are going to happen because prices are too low to effectively bring oil out of the ground at these prices in a profitable basis. So one way or another, the market's going to rebalance. When that's going to happen? Well, probably when the economies start opening up. But even then, I'm a little bit suspect because I don't think people are going to immediately jump in their planes. I don't think they're going to be jumping in trains or driving cars. So my view is here, there's going to have to be a cure, and that's probably going to be the ultimate cure-all for oil devastation, oil demand devastation right now. Herd immunity, a cure or a therapeutic means to eliminate this virus.
So, Bob, it seems like Stephen is saying that this isn't going to go away anytime soon. There's a 35 million barrel a day glut. How do you get out of that? What do you do with it?
Well, Stephen is exactly correct. You really can't regulate countries in terms of output. And in the states, the president can't tell producers directly to shut in. States can. Texas, in fact, used to have what we call proration, where each well that was produced in Texas actually received a monthly allowable from the State Railroad Commission. The Railroad Commission regulates oil and gas, which is kind of a weird thing for Texas. Texas has these strange names for things. So
I'm
the
a
Railroad
Texan.
Commission regulates oil and gas. But there's a lot of talk in the industry right now about starting proration up again by the state. Economics do work, though. Wells are shut in right now just because of economics, and I think several more million barrels are probably going to be shut in the states alone.
What about what President Trump was saying about buying more for the strategic stockpile? How does that work?
That's a Band-Aid. It's just a Band-Aid. The strategic reserve is like, I think 775 million barrels, something like that, and it's like 2/3, 3/4 full now. So it's just a short-term solution. It doesn't fix the glut problem. The glut problem is solved by shutting in, reducing supply, or conquering the virus and starting to use hydrocarbons again. Until then, the glut's going to continue.
Cornelia, I want to go back to something that Stephen mentioned, and Bob touched on it as well, this concept of, there wasn't a lot of global coordination in dealing with this coronavirus, unfortunately.
Well, at this point, what was tried was this 9.7 million barrels a day from OPEC plus being taken out, with another up to 15 million barrel with the G20 countries, the latter only by natural attrition because they could produce less. But that's not enough. If you look at the IEA, which says it's the demand destruction for April alone is 29 million barrels a day. So there will be shut-ins. But what I would like to point out, which I think is important, yes, it will get better, and the IEA, the International Energy Agency, says by the second half we'll have a demand overhang because so much will be shut in by then. But even if we get there, the world will not revert to usual. It will take time until people travel. And the other thing is supply chains. The supply chains will have realigned. We will see regionalization of some of the supply chains, and that means less transport. That means less oil demand. So the shape of the oil demand and where it's coming from will probably have changed in the post-COVID-19 world.
Stephen, what does this mean for the shale industry, which, the shale industry already wasn't doing well. What does this mean for the shale industry?
I think it means it's pretty negative, really, when you think about it. The prices remain depressed for a long time, just based on what it costs to bring shale out of the ground relative to the lower producers like Saudi Arabia and Russia. And even there, the break-evens we're getting pretty close to those levels right now at a WTI-based level. So it's pretty shocking, really. I don't know how things are going to survive. CapExes were already getting reduced. Basically everybody is a price taker right now as far as oil. Looking at any city that's a price taker is suffering, just not shale industry. This is a global problem. I think a lot of countries, you look at KL in my region, Kuala Lumpur is a big price taker. Singapore is a big price taker. Calgary, Houston, these are all big price takers. We're going to see a lot of pain and a lot of support industries, not just necessarily the people who pull it out of the ground, but a lot of industries that go to support this industry. It's going to be a lot of pain throughout the markets, especially in the unemployment or especially in the employment area.
I want to bring Bob into that conversation. That was actually my very next point, is what is this? We've talked a lot of business, and business is significant. Obviously, what does this mean for the average person that is a worker in the oil and gas, the energy industry? What does this mean for them, Bob?
Well, Houston's becoming a layoff city. It's one of our largest industries in Houston. Houston's the universe for U.S. production. And here there's hundreds of thousands of jobs that are tied to either directly producing crude or the ancillary services around it. So the companies are already walking thousands of employees now. Unemployment claims in Texas are through the roof. All the companies now, except for a few operation centers, are operating remotely, and a lot of companies have just shut down. We've lost quite a few rigs that have been just laid down, drilling stops. So all those drilling crews are now laid off. Production crews, pumpers, engineers. It goes for the whole gamut from executive down to the back office folks. This is a catastrophic price drop. It's going to take, and the thing about these kinds of cycles, normally it takes about 1.5 2 years to come back from one of these down cycles, 2001, 2009, 2015. This, because you've got the drop in demand that may never come back in terms of coming back to the 95 million barrels a day global demand. This could be a permanent just step down in demand and employment as results from that lower demand.
Which goes to Cornelia's point that when this is all over, things will definitely not be the same. Do you want to add to that, Cornelia?
Yes, I wanted to add to that. You mentioned CapEx, and that's very important. When you see how CapEx has also come down by the IOCs, all of the international oil companies have announced CapEx cuts. And something I've seen for the first time, usually when you had a downturn, the IOCs, the international oil companies, the independents would limit their capital expenditure. But this time, for the first time, I see the national oil companies in the Gulf, in the GCC, the Aramcos, the ADNOCs of this world, also curbing the production. And that actually can be quite bad because oil is not like a light switch. It takes, in the shale space, 18 months from an investment to production. Offshore, it can take 10 years from investment to production. So when demand comes back, we may have shut in so much, and it may really be difficult to ramp production up again quickly enough because just so much is shut in.
Stephen, as you all have all agreed to, in a lot of ways, the industry tends to do these types of things to themselves. Is this any type of wake-up call or any type of lesson going forward for maybe how the industry needs to change or evolve, or does this create room for a different type of energy?
I think you've already seen the switch in big oil already moving to more green energy. And I think, just looking at some of the the progress that's being made in the green energy, this is obviously a threat to the oil producers also. But the big oil is moving in that direction. I think that's the change that's afoot right now. Going to be a move to ESG, and that's the way things are going. That's the way the public wants it to go.
Bob, you agree with that?
Oh, absolutely. The only way the oil and gas companies are going to survive long term is to adapt. The one thing about the oil and gas business people need to understand is if you don't like the oil and gas business and what it's doing right now, just wait about 5 minutes. They have to change in order to keep up. And here you're seeing it already. Stephen's right. You're already seeing larger companies begin to move to more renewable, sustainable kinds of energy sources to adapt to the reduction in crude demand. It's sort of like when the light bulb was invented. The candle companies weren't doing all that well. And so they either went out of business or they adapted to light bulbs. It's going to be a similar change long term for the energy structure space.
Cornelia, you get the final word. Do you agree that this might be a little bit of an opening for a necessary change?
I think it might be on one hand, yes, it might be on the other hand, because if you look at especially the international oil companies, yes, they're moving aggressively into the green space. But as they're cutting CapEx, they may, it's still not core. So we'll have to see how this shakes up, and also in terms of governments who, want to do more green things, greener, ecologically better energy production. Well, we may be so cash strapped when we come out of this crisis that the money for those investments is not there. So yes, ideally it would be, as the two gentlemen mentioned. I'm not sure we are living in an ideal world.
That's probably the best place to leave it. I don't think we are either, but we'll see. And thank you all for the conversation. Appreciate it very much. Bob Kavanaugh, Cornelia Meyer, and Stephen Ennis. And thank you for watching. You can see the program again anytime. Go to our website, aljazeera.com. For the discussion, go to our Facebook page, facebook.com/AJ Inside Story. You can also join the conversation on Twitter. Our handle is @AJ Inside Story. From me, Michelle Carey, and the entire team here. Bye for now.